Hello, everyone. Thank you very much for joining us once again today and welcome back. We are discussing transitional rules, the impact of transitional rules, how the transitional rule will work, and how the businesses will enter from the non-tax era to the tax era. As usual, first of all, we'll be discussing whatever we have discussed till now. We have discussed 26 different topics in different 26 webinars. The last session was on the small business relief. Before this, we discussed transfer pricing and its importance, application of corporate tax on the manufacturing and processing firms, application of corporate tax on the trading companies, participative interest and its taxation, free zone consultation paper were discussed in detail, free zone relief, tax losses, tax grouping, scope of the corporate tax, permanent establishment, application of corporate tax on the partnership, free zones, how to compute the taxable income, unrealized gains and losses on assets and liabilities, deductible expenses, interest capping rules, all these things that we already discussed in our previous webinars. Our today's topic is a transitional rule. For the transitional rule, what is the basically importance of the transitional rule? The transitional rules are quite helpful for the smooth transition from the old era to the new era, from world without corporate tax to the world with corporate tax. These transitional rules are quite helpful that it will not have any the corporate tax law will not have any disruptive impact on the businesses and individuals. By providing for the smooth transitional provisions can help us to minimize the cost and uncertainties associated with the implementation of the new corporate tax law. Article 61 of the UAE Corporate Tax Law deals with the transitional provisions. There are 4 clauses in this article. The first clause is opening balance. What the law says exactly, opening balance sheet for corporate tax purposes shall be the closing balance sheet prepared for financial reporting purposes. Under the accounting standards on the last day of the financial year that ends immediately before their first tax period commences. So when the first tax period commences, before that, the financial year ending, by the end of that financial year, businesses and taxable persons are liable to prepare their financial statements by applying the accounting principles, accounting standards applicable in the market. So whatever the closing balance sheet as per the closing balance sheet as per the applicable accounting standards for the respective financial year, those closing balance sheet will be carried forward and it will be transferred as an opening balances for the corporate tax. Second thing they are asking, these opening balances shall be prepared keeping in view the consideration the arm length principle. This is the most important thing. So whatever my closing balances are coming into the balance sheet which has been prepared as per the applicable accounting standards, whatever the closing balance sheet I have as per the IFRS accounting standard of the last financial year, that closing balance sheet number, whenever these be carry forward, the law requires this should be on the arm length principle. We know what is arm length principle. Arm length principle, we have discussed just in one line, whatever the price of the goods and services for the related party or for the connected person, it should be the same price when these goods or services are being sold to third party. The price that is being charged to third party at arm length, the same price should be charged to the connected party, to the related parties. It should be arm length price. We'll discuss the reason behind this as well. What was the reason? The reason was the chances are there the profits will be moved from the high tax jurisdiction to the low tax jurisdiction. And chances are there might be the people are keeping some expense quite high for the connected party just to bring their taxable profit low, which is not as per the market price. So TP rules and regulations will come there. So this is the requirement of the law. So whatever the closing balance for the last financial year, it should be carried forward as an opening balance for the first tax period. And these opening balances should be as per the arm's length principle. Third class is anti-abuse rule exceptions. We know this anti-abuse rules that, but the anti-abuse rule we can look into this in detail. Then what is the requirement of the Article 7? What is the requirement of Article 50? What are the exceptions over there? And last thing they are asking, the cabinet may issue a decision prescribing other transitional measures related to the implementation of the corporate tax law. Now we'll discuss these clauses one by one. So the first clause 61(1) of the corporate tax law requires that the opening balance sheet for the corporate tax purposes of the taxable person shall be the closing balance sheet prepared for financial reporting purposes under accounting standards applied in the UAE. So this is your financial period, assuming 1st Jan till 31st December 2022. This is financial year. And your tax, assuming you are falling in the bracket, is your financial year, your effective tax period will be starting from 1st of Jan 2023. From this date, 1st of Jan 2023 till 31st December 23, this will be your tax period. So what the law says? Law says for this period, 22, the financial year that immediately ends before the commencement of first tax period, businesses need to prepare their financial statement as per the applicable accounting standards, and whatever the closing balances reflecting in the balance sheet, these closing balance sheet balances will be carried forward as an opening balance for the first tax period starting from, in this case, from 1st of Jan 2023. I think this is very clear that all the businesses need to prepare the financial statement before going into the tax world, and they need to prepare the financial statement based upon the respective accounting principles. We know this, what is the requirement of the law up to 3 million, more than 3 million, less than 3 million, that we'll discuss in detail in the next thing. So this is the same example that I discussed in our previous page. X Limited has financial year from January to December. This is Jan to December. This is their financial year. And effective tax of law for X Limited is 1st of Jan 2023. For X Limited, effective date of the law is 1st of Jan 2023. X Limited first tax period will start from 1st of Jan 2023, and their immediately preceding financial year is Jan 01 2022 till December 31st 2022. For the financial year of 2022, X Limited will be liable to prepare the financial statements and number reflecting in the closing balance sheet. This is important. We need to carry the balance sheet number reflecting in the closing balance sheet of year 2022 will become the opening balances for the tax period starting from 1st Jan 2023. When the financial statement will be prepared, there are multiple elements are there. We know this balance sheet is there, statement cash flow is there, statement of changes of the comprehensive income is there, profit and loss is there. The only whatever the balances reflecting in the balance sheet, these are the as on balances. These balances will be carried forward, and these balances will become the opening balances for the first tax period starting from the beginning, starting from, in this case, starting from 1st of Jan 2023. If no accounts were prepared for the previous financial, there are possibilities that companies or businesses in the market, they are not preparing the financial statement. If the companies and if the businesses, they are not preparing the financial statement, means they will not have any closing balance. So what they need to do, law requires you need to carry forward the balances, but the companies and businesses are not preparing the financial statement. This is the requirement of the law. Closing balance you need to carry forward if you are a taxable person. So what we need to do, we need to prepare the financial statements before entering into the tax world. We need to prepare, businesses, taxable person needs to prepare the financial statement before entering into the tax world. And what are the basis for preparing the financial statement? These bases can be applicable accounting standards. We know this. As per law, business can use cash basis of accounting, businesses can use accrual basis of accounting, and businesses, if the turnover of the business is less than a maximum up to 50 million, in this case, they can use Accrual basis of accounting by applying IFRS for SMEs. If the revenue is more than 50 million, they need to apply full-fledged IFRS. If the revenue is less than up to 3 million, they can apply cash basis of accounting. By the way, you can, if the businesses are not preparing the financial statement before entering into the tax world, in a world with taxes, then what they need to do, they need to prepare the financial statement, and they can apply these three modes as we discussed: cash basis if the revenue is up to 3 million, accrual basis by applying IFRS for SMEs if the revenue is maximum up to 50 million. If their revenue is more than 50 million, then they can apply full-fledged IFRS and they need to prepare their financial statement. Once they will have the financial statement, they will have the balance sheet. Once they will have the balance sheet, the number reflecting in the balance sheet, it will become the opening number for the tax period. Clause 2 of the Article 61. What the clause 2? Opening balance for the first tax period should be based on the arm's length principle. This is a very, very, very important point. This is a very key point. Now, might be the businesses are in the market, they are having a transaction with the related party, might be they have a transaction with the connected parties. And once they have a transaction with the related party, once they have a transaction with the connected parties, might be they are selling to the related party below the market price, might be above the market price, might be on cost to cost basis. There is a possibility. If they are selling to the related party on cost to cost basis, means arm's length principle is not being followed. If they are selling above the market price, means arm's length principle is not being followed. If they are selling below the market price, means arm's length principle is not being followed. But we need to stick to the arm's length principle. This is the requirement of the law. My balance sheet, the balances reflecting in my balance sheet that I have prepared as per the applicable accounting standard, might be there is a possibility that the balances are not as per the arm's length principle. Once the balances are not arm's length principle, what we need to do? The question is what we need to do. In the balance sheet, whatever the balances are reflecting, these are the as on number. When the businesses was started, balance sheet is carrying all those numbers. Might be someone has started the business 50 years before, 100 years before, 20 years before. The impact will be reflecting into the balance sheet. So do you think we need to go back for the last 50 years? 100 years, 20 years, we need to revise the balance, then we need to carry forward the number, we need to make the adjustment. These are my questions that we need to discuss. So these are the key questions, how we will adjust the opening balances. Law requires that we need to adjust the opening balance. We need to adjust the opening balance as per the arm's length principle. Then how can we do this? So for this purposes, what is the best possibility? What different options can be there? First of all, we need to segregate the financial statement. What are the financial statement? In those financial statements, I need to take only balance sheet. Once I'm taking balance sheet, so what are the options that I can do? For the balance sheet, we can have multiple options to adjust the balance sheet. How we will adjust, we will look into this. So how can we adjust the opening balances? Might be the transaction or between related party, as I discussed, might be the transaction or with the connected party, might the price is above the market price, below the market price, at cost to cost basis. We need to adjust it to apply the transfer pricing rules. Just look into this example. Suppose in 2022 or earlier year, at the time of preparation of financial statement, will they be able to recalculate the number based on the arm's length principle? As I discussed earlier, might be the company has a history of 50 years. Do we need to go back and recalculate the number for the last 50 years? Do we need to go back and recalculate the number for the last 10 years? I think this is very hectic exercise and nobody will be able to do this. So how can we do this? Just look into another example. X Limited paying any salary to the connected person, owners, officers, or their related parties above the market prices in 2022. Will it be adjusted? Now 2022, if the higher salary was being paid to the connected parties, it was not up to the market, it was beyond the market, below, very high beyond the market, then definitely it will lead to lesser accounting profit in the previous year and lesser ultimately if the profit is converted or retained earning, lesser retained earning. So what will be the impact? In the same way, if X Limited has sold any goods or services to the related parties above or below the market price in 2022, will it be adjusted as well while closing the books of 2022? Another case where business is made non-arm's length transaction with the related parties. and connected person in 2022 or before 2022. My question is, the impact of these transactions is showing in the opening balance of the balance sheet for the year 2023, for the tax year 2023. Will they be able to pass the adjustment for the previous period to arrive at the balances as per the arm's length principle? Federal Tax Authority has given, the ministerial decision has been issued on this. The title of the ministerial decision is Transitional Provisions. But the question is, does this transitional provision address all these questions? This transitional provision, I have taken this frequently asked question. In our coming webinar, we will discuss this transitional provision, all the related effects in detail. But what does this transitional provision, what is this ministerial decision 120 of 2023 deals with all these questions? So what are the types of asset and liability that taxable person may elect to adjust? This transitional provision, this ministerial decision 120 of 2023 deals with the qualifying immovable property. It deals with the intangible assets. It deals with the financial assets, deals with the financial liabilities. So when should the election and anyone who is submitting the return at a time of submission of first return, you can opt and make these adjustments. Does this adjustment pertain to the question that we have discussed? No, not at all. These adjustment pertains to the gain or loss related to the immovable property. These adjustments related to the gain and loss related to the intangible asset having a life not more than 10 years from the date of the effective date of the law. These deal with the gain and loss related to the financial asset, financial liabilities. So we cannot consider this ministerial decision for our all previous questions. What about my questions? If the business has as a number for the last 50 years, 100 years, which are reflecting in the balance sheet, do they need to go back and adjust the opening balance to bring this as per the arm's length principle? This was my question. And this ministerial decision 120 and 2023 doesn't deal with these questions. This is adjustment of gain and loss. Adjustment of gain and loss has been very clearly written. See, this is basically how will the adjustment, you can see in the amount of gain. Second, amount of gain and loss will be adjusted. Third, amount of gain and loss will be adjusted. Fourth, exclude the amount of gain and loss. So this ministerial decision doesn't deal with our question, which is how to adjust the opening balances. They have given one more provision. If the provision is there in the balance sheet, this provision, when it will be released, it will go back to the profit and loss account. Once it will go to the profit and loss account, it will be considered taxable income, by the way. We'll discuss in our coming webinars. So my question was how to calculate, how to restate the opening balances as per the arm's length principle. Law is like keeping only just one line. Law is asking you need to take forward the numbers from the closing balance sheet, but these numbers should be as per the arm's length principle. So what I think, just look into this. This is a possibility. What I am looking into might be we'll get some sort of decision, some sort of clarification on this as well. What is the possibility? Just look into the number. First of all, I believe it will be applicable on the outstanding balances. This clause, the businesses that will be carried forward, these clauses that whatever reflecting in the balance sheet, the two possibilities that I mentioned. Previous period impact can be in the retained earning. As an impact can be into the assets and liabilities, which will be reflecting on the face of the balance sheet. So if the impact was in the retained earning, I didn't think so, we need to open it. Might be there is a possibility. This is not conclusive. Nothing has been given on the law. How will adjust it? My questions are still there. Because previous period impact will be in the retained earning. Previous period will be impact, maybe it may be in the assets, maybe in the liabilities. So how it will be in the assets? Like if we bought an asset from the related party below the market value, asset is still with the business, means impact is there. If we have sold any asset to the business, receivable there, impact is there. Might be in the same way, liability impact is there with the related party. So previous period impact can be in the retained earning, or it can be into the assets or liabilities on the face of the balance sheet. I didn't think so. We need to open the retained earning, but might be yes, we need to wait for the law. So what I think, what I believe, first of all, we need to look into the opening balances. Whatever the balances that has been settled earlier, these rules, these provisions of the law will not be applicable on those settled balances. So settled balances have gone. Now the remaining, whatever reflecting on the face of the balance sheet might be financial assets are there, intercompanies are there, all these things. We need to look into outstanding balances. Carry forward balance sheet balances not on the profit and loss account. Second thing, we will carry forward only items as per balance sheet. We will not carry forward anything related to the profit and loss. That impact will always be there in the retained earning. TP issues arises on transaction with the related parties and connected person. Unsettled transaction previous period P&L impact will be in the retained earning. Unsettled transactions previous period impact will be previous period impact related to the profit and loss account. It will be in the retained earning. Unsettled transactions previous period balance sheet impact will be on the face of the balance sheet. And this will be in the face of on the face of the balance sheet in the form of intercompany, might be financial asset, financial liability, or it can be any asset or liability as well. Like I already given you an example, like one party bought machinery below the market price from the related party in 2022. So the machinery will be showing in the balance sheet at non-arm length price because the machinery has been bought below the market value. So machinery will be face of the balance sheet. Intercompany will be an asset can be there, liability can be there, retained earning will be there. That will be carrying the previous period impact. Either mentioned as retained earning, assets or liabilities. So I believe we will not be required to adjust the impact of retained earning because retained earning are coming from the profit and loss, and this profit and loss is for the period only. It will not have any impact in the future period on the amount of any tax payable to the FTA, to the government. So we will not be required to consider the retained earning. Remaining settled balances, we have already excluded. Remaining on the face of the balance sheet, unsettled liabilities, unsettled assets. And these unsettled liabilities, unsettled assets, all are not relevant for us. We need to look into this only transaction with the related party. If the transaction is not with the related party, means this is already at the arm's length. We need to look into the transaction only with the related party, only with the connected party. So whatever the balance sheet we will have, we need to remove retained earning. We will have intercompany, we will have assets, we will have liabilities. We need to identify the transaction with the related party. Once we have identified these are the unsettled outstanding transaction with the related parties, now we need to go back to the transaction. This is what I believe. Might be no, might be they're given some sort of clarification, but I believe we need to go back to the transaction and we need to look into the each and every unsettled transaction with the related party. We need, I'm repeating, this is what I believe. This is my personal opinion. Might be I have a different point of view. Tomorrow FT is giving us any clarification which is altogether different from here. But I believe for the unsettled balances with the related party, we need to go back. We need to identify what was the market price and what is the price at which these goods or these services were settled in between the parties. Then we need to make an adjustment to bring the balances as per the arm's length principle. Whatever the revised balances, those revised balances will become my opening balance for corporate tax purposes for the first tax period. If required, I can repeat it again. So whatever we have just decided, retained earning, it will have a further period impact, it will be removed. Remaining will be assets, liabilities. Out of these assets and liabilities, a lot of things will be there. There is nothing to do with the related party, connected party, those will be removed as well. Whatever the remaining transaction, remaining outstanding transaction, unsettled transaction with the related parties, I believe we need to go back. We need to identify the transaction. We need to bring them as per the market value. We need to adjust the closing balance sheet as per the latest financial year to arrive at the opening balance for the first tax period. Anti-abuse rule. Anti-abuse rule, Article 70 of the law says that the law will be applicable within 15 days from the date of announcement, or they are using the word within 15 days from the date of publication. But these anti-abuse rule specifically related to this transitional provisions, law is asking this is an exception, and these will be applicable. There is no grace period of 15 days. These will be applicable. So for the purpose of clause 1 and clause 2, we know what is the clause 1. They are asking to prepare the financial statement for the latest financial year. Clause 2, they are asking to bring the closing balance as per the balance sheet, as per the arm's length principle. They are asking for the purpose of clause 1 and clause 2 of this article, as an exception to the provisions of Article 70, publication, application of law within 15 days from the date of publication. The provisions of Article 50, which is anti-abuse rule of this decree law, shall apply to a transaction arrangement entered into on or after the date the decree was published in the official gazette. There is no further grace period of 15 days for the transitional provisions. So anti-abuse rule, we know what is the purpose. Basically, they are asking if there is no commercial sense, if any businessman, any taxable person is trying to avoid the tax, there is no commercial sense, then it will be considered anti-abuse. This will be abusive just to avoid the tax. Anti-abuse rules are there. Law is asking you cannot do this if there is no any commercial sense for this. So this is the reason that the general anti-abuse applicable preparation of opening balances with respect to transaction arrangements entered on or after the date the law is published in the official gazette. This permits the FTA to counteract arrangement put in place for a transaction entered by a person before they become subject to corporate tax arrangement anyway. So these are discovered anti-abuse as well. So we are always happy to help impact assessment, implementation, advisory services. You can contact me, my team. We are always there. We are always ready to listen, ready to understand, and ready to deliver. You can approach us at info@crestcooper.com. You can give us a call as well. So this is all from my side. If you have any question, you are most welcome. Whether recording will be shared. I have already requested that you can follow our YouTube channel. This is, you can find on YouTube Press Cooper, and you can find the recording there. I can put it here as well. Answer. No. Anyway, you can find our YouTube channel. You can type answer live, type answer. You can search Press Cooper on YouTube. You will get all previous webinars there. How to determine what amount of salary for owner? Director is under arm's length. The director is taking 80K per month, which next most senior staff is taking, FM is taking 15K. In the guide, in the law, they said that the salary, it should be as per the market price. What is market price? Law is silent about this. So what are the possibilities? One possibility is there, might be the FTA will give any clarification. Okay, this is the maximum ceiling, this is the middle tier, this is top tier, might be some sort of brackets they are giving. If they are not given, I strongly recommend all of you that you need to go through the surveys published by the various recruitment agencies. You can find the salary there. You can keep it as a basis for your salary. So it will be very solid reason to justify tomorrow in case FTA is coming and conducting the order, they are asking any question, will must have a solid basis. So you can go through the various salary surveys and you can keep it as a basis for this. Okay, question. For unsettled related party balances, if transactions were made at non-arm's length price, what entry would be passed for opening balance, related party balances, debit? It all depends basically what was the impact on the balance sheet. If you bought the machine was underpriced, might be you sold it, you bought it. It all depends basically what nature of transaction. If you already bought the machine, the price of the machine needs to be increased, related payable needs to be increased. If you are sold, receivable needs to be increased, related transactions. So it depends what type of transaction it was. New Zealand tax understanding is also available. New Zealand tax understanding is also available. Yeah, we can help you there in New Zealand as well. If you are in need of any sport, it will be players supporting you. So thank you very much, guys. If you have any question, you can drop me an email and you can give me a call as well if you got. It will be players supporting you. Take care. Thank you very much and have a lovely day. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.